Good evening, like, and hello, everyone. So we are group one. We're going to present from the book called "Finance for an Equitable Recovery," and we are responsible for the first part, which is overview and introductions. And our group consists of 6 members: that is me, Thida, Danit, Vishal, and Vijamian. Yes, so next slide, please. And here is our table of contents. First one is in overview, which is the economic impact and the policy. Second one is conclusion. Third one is introductions that talk about the impact on household, firm, um, financial sector, and public finance. And the last one is the government response, which is cover only the short term. Next slide, please. Yeah, so here I'll begin with the first part of our presentation. First one is the overview. In 2020, as a community around the world, uh, were struggling to contain the spread of COVID-19. The first year of this pandemic, the global economy shrank by approximately 3%, and global poverty increased for the first time in a generation. So government implemented a wide range of crisis response policy to mitigate the worst social and economic impact of the pandemic by enacting or implement a swift emergency policy response that use a combination of the fiscal, monetary, and financial sector policy to limit the impact of the crisis on household and business, or to manage the health and human costs. As the case of India, which, like many other countries, enacted a large emergency response to the first wave of pandemic, offer an example of decisive policy response that use a wide range of policy instruments to mitigate the worst immediate effect of this crisis. When the pandemic first erupted in India in March 2020, the government declared a 2-month national lockdown that closed businesses and sent workers home. The lockdown halted all manner of economic activity and income loss. Small business and low-income workers in urban areas and the informal sector were the most severely affected. The first measure adopted by the Indian government was the fiscal stimulus package that amounted to nearly 10% of the GDP and include direct support for poor households. Second measure is monetary policy is to reduce the interest rate and ease lending condition for bank and non-bank or financial institutions. And the last measure is financial sector policy, were also part of the support plan. India instituted a debt repayment uh, moratorium for household and firm government, and government also introduced a large credit guarantee scheme aimed at ensuring that small and micro enterprises would continue to have access to credit. Next slide, please. Yeah, so here my second slide, where I'm going to present you about the economic impact of the pandemic. And the first one is interconnected financial risk. So India response to the economic crisis was similar to many other countries. The strategy recognized that the sector of its economy, household and businesses, financial institutions, and government are interconnected. A large shock to one sector can generate spillover risk that destabilize the economic at large if not addressed properly and in an integrated manner. Although household and business income were most directly affected by the crisis, the consequence of this large shock have spread to the entire economy. Because of these interconnections, elevated financial risk in one sector can easily spill over and destabilize the wider economy if the government still cannot provide a good policy. Yes. So So when household and firm are under financial stress and financial sector face the higher risk of the loan default and is less able to provide credit. Similarly, when the financial positions of the public sector deteriorate as the result of higher debt and debt service, its ability to support household and firm may weaken. Financial health of household businesses and financial sector. Um, so in response to lockdown and mobility restriction necessary to contain the virus, many government supported borrowers through direct cash transfer and financial policy tools, including debt moratoria and credit guarantees. As the crisis unfolds, this policy provided much needed support to households and small businesses and have avert a wave of insolvencies and loan defaults. Similarly, government, central bank, and regulator also use policy tools to assist financial institutions and prevent financial sector risk from spilling over to other part of the economic as well. In many countries, central banks usually lower interest rate, like injected liquidity into the market, which reduce the interest rate on new credit or the new loan. And central bank also uh, also use the unconventional monetary policy tool as well, such as asset purchase program. 20s when emerging economy adopted such program for the first time in response to the COVID-19 crisis. This so I can say that this program usually aim at preventing a liquidity crisis and safeguarding financial stability. Next slide, please. And another slide here focus about the increase in equality within and between countries. The economic impact of the pandemic has been highly unequal within and between countries. As the COVID-19 crisis unfolded in 2020, it became clear that many households and firms were ill-prepared to withstand an income shock of the pandemic. In 2020, more than 50% of households globally were not able to sustain basic consumption for more than 3 months in the event of income losses. And around 20% of the countries, the incidence of the temporary unemployment was higher for workers who had completed only primary education. Income losses were similarly larger among youth, women, and self-employed, and casual workers with lower level of education. Women are women in particularly were affected by income and employment losses because they were more likely to be employed in sector most affected by lockdown and social distancing measures. And yes, and they also have the family to raise as well. Survey data collected by the World Bank up to July 2020 stated that 42% of the women lose their job compared with the 31% of men. Yes, so it is can cause an unequal impact of the crisis by gender. And similar pattern emerge for businesses, smaller firm, informal businesses, and those with more limited access to the formal credit market were harder hit by income losses stemming from the pandemic. Larger firms enter the crisis with the ability to cover expenses for up to 65 days compared to the micro enterprise only around 50 days uh, that they can do it. Many emerging economies, small and informal business account for large share of total economic activity and employment. For example, it is estimated that informal economy account for about 34% of GDP in Latin America and Sub-Saharan Africa and 28% of GDP in South Asia. Next slide, please. So here is my last slide that talking about the economic policy response to the pandemic. Swift, but with large variation across country. As the pandemic intensified in 2020, the size and scope of government support program varied widely. If you can see in the first picture, figure 04, show the variation across country in the scale of fiscal response to the pandemic. In many cases, fiscal emergency measures were supported by large monetary policy intervention. Several emerging economy central bank, for example, use unconventional monetary, monetary policy such as asset purchase program for the first time in history. This program supported the fiscal response and provide a liquidity at a time it was most urgently needed. These policy tools were both more widely used and more effective in higher middle income countries that had deeper capital market and a more sophisticated financial sector. By contrast, in more low-income countries, governments were constrained in their response to the crisis because their monetary policy was not able to play a significant role to support their country. The initial impact of the pandemic translated into rising inequality across country in large measure because of the constraint many governments face in existing household and businesses. And the last picture, which is the figure 05, which show the percentage of country uh, within a country income group that adopted different type of fiscal monetary and financial sector policy measure. The figure highlight some different in the policy that are explained by resource constraint, as well as some different that are explained by a difference in the nature of economic risk faced by different countries. High income and upper in middle income economy made much more intensive use of financial sector policies such as debt moratoria, given the financial institution in this country are much more exposed to household and more business loan, whose credit risk was severely affected by the pandemic, as the lower middle income and low income, they cannot provide the effectively of the policy that they want to implement to have the household and the business. So here is the end of my part. Please let our member to continue their part.
Uh, Thank you, Minnie, and again, good evening, lecturer and class. So you may know that the COVID-19 caused a lot of problem in the globe and affect all main sector in each country, especially the economic sector. And in this part, we'll be focusing on the resolution of on financial risk, which resulted from the economic crisis during the world pandemic, and all this problem occur has forced the government, regulators, financial institutions to pursue short and long-term policy for sustainable and equitable economic recovery. And according to the information provided, there are four timely action policies, and I am responsible for policy one and two. So now let's talk about the first policy, which focus on the managing and reducing the loan distress. So in this context, loan distress exists when the borrowers have no capability to repay their debt on time. And there are an increasing of the loan distress during the COVID-19, and it is more difficult when there is a large scale of debt release measure with the support from the government in some countries. So the debt release measure is the measure that used to reduce the debt, like to make it easier to borrow or to repay, and the measure that practice in a form of like forgiving a portion of debt, lowering interest rate, or delay the payment date. There is and when the debt release measure are practiced, there is an increase of NPLs, which is the non-performing loans. So the non-performing loans is the the type of loan which the borrowers hasn't made any payments or interest rate yet. And if the NPLs, non-performing loans, keep increasing, there would be like more stress on financial sector and like investment reduction. And generally, the bank can manage the number of um, NPLs or the increasing of NPLs in normal case, but but the banks as well as some financial institutions like have less or have not enough capacity to when it comes to the sudden increase of the non-performing loans during the COVID-19. And within the policy one, there are three key elements to support such a strategy of managing the non-performing loans. So first of all, the first key element is about the transparency. So it is the transparency of the bank asset. The policymaker needs to establish which incentives that support the transparency of the bank asset. During the world pandemic, people lost their income and the number of borrowers increased, which caused some complexity in accessing the bank assets. So according to this chapter, the robust regulatory is recommended for the bank supervisor to be like to use it enabled to cope with the variety of failure and to control over the risk in all circumstances. Yes, and the next element is about the loan resolution. So both the government and the bank shall intervene in the loan resolution. Like they are responsible, it's their responsibility, and like they can require bank to adopt any appropriate process to like recover the past due loan and manage the rising of the non-performing loans, and bank takes the primary responsibility to manage the loan distress, and the government or the public intervention also play the useful role in reusing the debt. Like the national NPL resolution strategy is one of the public intervention in which like all stakeholders in the country in the economy come together and work together to reduce the loan or the um, reduce the non-performing loans. And as an evidence, in 2015, after the global financial crisis, Serbia created the National NPLs Working Group to reduce the percentage of like NPLs, and it was a fruitful result. As the percentage of NPL increased in a remarkable data. And if you want to see the specific data, you can go like in chapter one. They provide like the specific data, and not only not only the NPL resolution strategy, but some country also created the uh, public asset management companies, or like it is called bad bank, to restore back the public confidence, reduce the number of non-performing loans, and to prevent unnecessary of fire sales. Fire sales here mean like selling the products below the market value. And the last element is about the problem bank resolution. So in case that the bank unable to absorb the increase of the non-performing loans and the financial stress during the COVID-19, the authority are able to deploy like the robust set, and should include the legal regime of like receive the funded from the private sector, and the use of the public money is the last resolution for the bank problem. So it is the end of the first policy in managing the loan distress. So now let's move to the second policy. Next slide, please. So in the second policy, it's focusing on improving the legal insolvency framework. So insolvency framework is necessary in financial system in the process of economic recovery. It is the rule the insolvency framework is the rule to determine how to resolve the distressed asset or the distressed loan. And as I said earlier, in the first policy, the distress loan is a type of loan in which the borrowers are not able to repay money on time due to some difficulties. So this policy aimed to improve the capacity of insolvency framework, since like it is facing some challenges when there is a sudden increase of loan default, and although the advanced economies find it difficult. However, in the process of improving the capacity of insolvency framework, it is critical in economic recovery. There are there are also four mechanisms within the second policy, as you can see in the slide. So first of all, strengthening formal insolvency mechanism. The insolvency mechanism include the incentive in which the debtor and creditor are able to cooperate and find a solution. Debtor means the one who owns the money, and creditor is the one who gave the money for borrowing. And in strengthening the formal insolvency mechanism, there is the implementation of early warning tool. Early warning tool is used like in order to prevent the debt not to escalate to the point of insolvency, like to the point that the borrower cannot are not able to repay the money back to the creditor. And the second mechanism is the alternative dispute resolution system, or ADR. So it provides the quicker and cheaper process than the court system. And specifically, the debtor and the creditor are able to engage directly and solve the debt problem or the loan problem, and they are also like involved by the third party as well. And the third mechanism is establish accessible in court and out of court procedure for small business. So the pandemic has hit the small business harder, and the small business and also the medium-sized business. And because of this problem, there's a reform design of the insolvency system. So the reforms include the increasing of the efficiency of debt structuring, allowing debtor to maintain control of their business when possible, making fresh financing available, and using out-of-court proceedings to keep the costs down. And the last mechanism is the to promote debt forgiveness and long-term reputational protection for former debtors. So during the pandemic, individual or small business like lose their income, and it lead them to borrow money from private sector, from banks, and so on. And those borrower has like various consequences during the pandemic, and yes, they somehow like have been devastated through no fault, like they have no choice, so they have to borrow money from other people to like support their current situation. And according to this reason, the court should solve the debt or loan problem quickly without no income or no asset case, like shouldn't exploit those debtor during the COVID-19, because like they have, as I said, they have like various consequences during this world pandemic. So this is the end of my presentation. Thank you, and I would like to give next floor to my next teammate. Thank you.
So the policy area 3 is ensuring continued access to finance. So many households and businesses are at risk of losing access to formal finance because of many factors coming from the pandemic. Especially small and medium enterprise who barely survive through the pandemic tend to be the first who cut off from credit. And it is difficult to estimate how long the country will take to recover their economy. And this uncertainty about economic recovery uh, uh, yes, the uncertainty about the economic recovery is the challenges to the financial institution. That moratoria and freeze on credit is the sorry. As for credit risk, normally companies are difficult to assess even in normal time. thus both bank and non-bank lending tightening the loan and only looking for the customer with the lowest risk. So with this reason, the access to finance is so much difficult during the pandemic. So for now, let's take a look at the strategic key for the resolution for finance access during the pandemic. The first one is mitigating risk by improving visibility and recourse. The pandemic have made it more difficult to access the credit of potential borrower and limited lender recourse when a borrower defaults. So there's a new data and technology that can be used to update existing risk model and increase visibility into the borrower ability to repay. For example, we have a Confio, which is a digital SME. SME refers to micro, small, and medium enterprise. The lender that leverage the electronic invoice and add alternative data to supplement traditional credit formation. And it also adapted its credit algorithm in the early months of the pandemic to integrate granular data on the impacts of COVID-19 on those small firms in Mexico. It then doubled its monthly loan disbursement during the pandemic. There's another option that we can use the other strategy to enhance visibility, include temporarily reducing loan tenor. Loan tenor refer to a repayment period or leveraging the digital channel to get a high frequency current transactional data. The second one is that supporting new lending by ensuring credit risk. Ensuring against loss can help to restore credit growth. The credit guarantee give lender recourse to the guarantor to in case of default by the borrower. The guarantee have been a component of pandemic response in advanced country and several emerging economies, and this scheme may continue to play an important role in the recovery economy. The last one, a policy area, is adopting policy to facilitate access and manage risk. Financial innovation has the potential to support responsible delivery of financial service. This and unsupervised financial innovation can pose risks for both consumer and financial stability and integrity. Government must do something to prevent responsible for the new innovation malfunctioning to protect consumer and financial sector stability. Modernization of the financial infrastructure to facilitate operational resilience and access include both hard and soft infrastructure to support the digital transformation that can help foster a more robust, innovative, and inclusive financial sector. Next slide, please. Next slide, please. Rizal. Yes. About the policy area for managing higher level of sovereign debt. The pandemic has led into a dramatic increase in sovereign debt. So what is sovereign debt? Sovereign debt is a country gross government debt, which is the financial liability of the government. The leverage total debt burden among low and middle income countries increased by roughly 9%. The debt distress is when a country is not able to fulfill its financial obligation, pose a significant social cost. For example, one study has shown that every year that a country remain in default reduce GDP growth by 1 to 1.5%. And high debt and lack of spending flexibility also limit the capacity of government to cope with the future shock. And moreover, the government is often the lender of the last resort private sector debt, uh, and it can be quickly become public debt if financial and economic stability is threatened in an economic crisis, and public assistance is also required. So, protecting the ability of the government to invest in public good is also to enable the central bank to deliver on its role as the lender of last resort, and also central goal of managing sovereign debt. So look at the key strategy. The first key strategy is to manage the sovereign debt to free up resources for the recovery. The country at high risk of debt distress can pursue several policies to make payment obligation more manageable. The options include modification of structure of liability and schedule of future payments through negotiation with creditor and debt reprofiling. A reprofiling operation could be helpful when a country has multiple loans to be repaid in the same year, and the country could issue new debt with a longer or more even maturity profile. The second key strategy is resolving debt distress. Once the government is in debt distress, the options to treat the problem are more limited and the urgency is greater. A primary tool at this stage is debt restructuring with a medium-term fiscal and economic reform plan. This requires of the understanding among all the parties until the debt is sustainable. And also, World Bank and IMF play the biggest or important role in debt restructuring and offering the financial financing to make the deal viable. However, restructuring the sovereign debt have become more complex because of there is a higher share of non-traditional lenders, and also domestic source of finance has also increased. In emerging economic, reducing sovereign debt have often required debt restructuring, but government also pursue fiscal consolidation to improve government revenue, fiscal balance, and debt servicing capacity. And the last key strategy is that looking ahead to improve transparency and reducing coordination problem. The surging in sovereign debt during the COVID-19 crisis led to the need of strategy that can facilitate effective debt management, debt negotiation, and access to capital market over the longer term. So the three broad initiatives stand out include greater debt transparency, contractual innovation, and the tax policy and administration reform. This slide, please. We saw next slide. And this is the conclusion for the chapter one. By addressing the interrelated economic risk produced by the crisis is a prerequisite for a sustained and equitable recovery. So in the end of the day, country we have to prioritize the most important policy action needed to avoid financial instability. So this is all my part.
Um, thank you for the floor. And since one of our member is having an exam today, so I would doing a backup presentation for this part. Yes. So firstly, it's about the introduction of the pandemic and how it affects on the economy. So, as you know, the COVID-19 pandemic has caused a global public health crisis because there are over 200 million cases and close to 5 million deaths worldwide. And the outbreak of the pandemic, it was quickly turned into the largest economic crisis in it more than a century. And as a country and um, emergency measures such as the travel ban, the mobility restriction, closure of the non-essential business, limitation on the public gathering, and the mandatory home-based work, and there are several effects on the economic activity. So, in responding, the household income, business revenue, and the employment declined dramatically, and also the small business like the low-income household and vulnerable population were affected, and the global poverty were increasing for the first time in the generation. So in the 2020, the economic output contract in the 19% of the country, while the world economy contract by the approximately 3%. And was the result of the truly exogenous event that generating both a aggregate demand and this aggregate supply stock. So, as the economic response to the pandemic, it will need to address the following areas in which economic fragility have been highlighted and worsened by the pandemic. And there are a few policy priorities that have been listed. So, first is to addressing the increased inequality within and between countries. It was a result from the highly regressive impact of the crisis. Next, to managing and reducing the interconnection financial risk created by the pandemic to prevent the spillover effect that can threaten the return to economic growth. Third is ensuring continued access to finance to help the household and business weather economic uncertainty and invest in opportunity. And lastly, to perceiving and restoring the market transparency to enable a prompt recognition of the economic risk. So from this introduction, we will be exploring the short and medium term implication of the COVID-19 crisis for emerging economies. So it begins by the documenting the dramatic immediate impact of the crisis on the household and business which were most immediately affected by the income loss arising from the pandemic. There's also highlight on the unequal economic impact of the crisis within between the country and the like government response to the crisis, which also make a use of many unprecedented policy tools, and it was relatively successful at the in mitigating the worst effect of the crisis in the short run, but it may also create a longer term economic risk that pose an obstacle to the equitable recovery. So can you move to the next slide, please? Yes, next part is about the impact on household. So household is one of the income and employment that were heavily affected by the COVID-19 crisis. And based on the survey data covering 51 countries, it revealed that 57% of the firm reduced employment during the first two quarters of the pandemic, and it was directly affected to the household income. And similarly, according to the World Bank, the high frequency phone survey from a sample representative of 1.4 billion adults in 34 low and middle income countries found out that their average more than a third of respondents stopped working because of the pandemic, and 34% of the household experienced the reduction in income. So you can see in the figure 1, and it also showed that the employment income effect was compounded by the steep decline in the remittance in this country. And lastly, over 16% of the household was report receiving less in the remittance since the outset of the pandemic. So it it also showed that the aggregate nature of the economic stock also made it more difficult for the low-income household to rely on the risk-sharing mechanisms such as the informal credit and support for the social network. And this is also the high income tend to be the one who is not really affected by the crisis. Move on to the next slide, please. Visa, next slide. Yes, thank you. Next slide is about the rising global poverty. So, if we talk about the global poverty, it has the increase for the first time in the generation. So, according to the figure 2, is showing the global annual change in the extreme poor between 1992 till 2020. So, in this period, the poverty increased only twice. So it was during the ASEAN financial crisis and the COVID-19 pandemic. So during the 2007 till 2009 global financial crisis did not lead to the increase in global poverty because its effect was felt primarily in the advanced economy, whereas most emerging economy, where the majority of the world poor live, remain relatively unaffected. Although the full consequence of the COVID-19 crisis on the poverty are still highly uncertain, and it estimates suggest that COVID-19 will have a significantly greater negative impact than the ASEAN financial crisis, and this increase in the poverty is likely to persist as unequal access to vaccine and the possibility of the future wave of the pandemic pose obstacle to the recovery. So, looking to another figure, is figure 3. It shows the global trend in the extreme poverty from 2015 to 2021. So from the project year of 2020 and 2021, the bar showed that the change in the poverty rate if the prior trend have continued and compared with the estimated poverty rate adjusted from the impact of the COVID-19 crisis. So, whereas before the pandemic, it showed that 675 665 million people were projected to live in extreme poverty in 2020. And after the onset of the pandemic, the projected number of the poor increased to 732 million. So this number has suggests that the COVID-19 can you move to the back slide, please? Yes, yes. This number suggests that the COVID-19 setback the progress on the poverty reduction at the global level. So, yes. So on the next slide is about greater inequality across and within the country. So the impact of the crisis on household has been highly regressive across the within the country. In the early evidence suggests that in 2020, per capita gross domestic product, the GDP, have declined more than higher income country. However, this data may not be tell the fully story because of many households in the low and middle country work in the informal sector, and the impact of the pandemic on them is higher to assess. And it is one of to be notable that the impact of the pandemic on this country is being underestimated. So, according to the low and the lower middle income country report a higher prevalence of the food insecurity and have and of the having resource of the coping mechanism, such as the selling asset or the depleting emergency savings. So as you can see in the figure of 4, so it has shown that the recovery so far has been similarly and even across country with even in economic further over. So all has been much better than the emerging economy, while the low-income country which face risk to their growth outcome because of the unequal access to the vaccine and pre-existing economic fragility. So beyond the immediately impact of the pandemic on the income and employment, there are also the channels through which the crisis is likely to aggravate inequality across the country in the longer term if the pandemic have been continued. So one such channel is pandemic related disruption in access to education. So estimate that based on the data from the 157 countries suggest that the COVID-19 pandemic could lead to a loss of between 0.3 and 0.9 year of schooling adjusting for the quality. Moreover, the COVID-19 economic crisis has also been unique in gender inequality as well. So again, according to the phone survey data, colleagues have shown that during the first month of the pandemic, 42% of the women stopped working either temporarily or permanently, and compared with the 31% of men, women were proportionately affected by the income and employment loss because they were most likely to be employment or owner of the firm in the sector, and it is most affected by the lockdown and also the restriction of the social distancing measures such as the um, it was include like some of the service, the hospitality and some of the retail, and there's this job where the demand stock was hitting hard there. So female lead business were also less likely to have received the public support. Can you move to the next slide, please? Yes, thank you. Next point is the heightened fragility on the household balance sheet. So, the impact of the income loss substance during the pandemic were intensifying by the fact that many households were already financially stressed at the beginning of the crisis. So, the household can accommodate income stock by financing consumption with liquid financial asset, reducing expenditure to the bare maximum. So based on the figure 5, it shows that the share of the household who's resilient to the total income loss fall below the 3 months, 6 months, and 1 year for the sample of 24 emerging and advanced economy. So which is compared to the data that are available link. So the figure have revealed that the percentage of the household not able to sustain basic consumption, and it is beyond in terms of 3 months in the higher in the emerging economy than in the advanced economy. But on the other hand, the percentage of the household that cannot self-sustain beyond the year is particularly identical. It was reaching around 70% in both emerging and advanced economy. So if you take a look into the figure set, you will see the result of the exercise that first consider the effect of the debt relief program on the household resilience. It revealed that if all household debt repayment were pushed by law or household resilience, it would improve only marginally for the advanced economy, and it would be unchanged in the emerging economy. So there's also a part of the that relief as a policy tool is largely ineffective because in a emerging economic country, it is mostly the wealthy and therefore inherited more resilient household that it can accept for more credit. And this kind finding also suggests that the debt release may be have a adverse distribution effect because it benefit the primary wealthier household while the cost of the policy through the taxation is bound across the population. So similarly, on the figure 6, it has show if the household were able to liquidate their illiquid financial assets such as the retirement account, it would have also like almost no effect in the emerging economy and only short life benefit in advanced one. So roughly 40% of the advanced economic household would continue to be vulnerable segment after the initial shock. So it was not surprisingly that a policy instrument that dramatically reduced the vulnerability in both emerging and advanced economy is directly income support. So in short, um, the income support replacing the 50% of the regular income bring the total of the fraction of the vulnerable household to near zero for the first segment in both sets of economy, and this finding is also underscore the immerse of the value of the large cash transfer used worldwide to enable of the household to weather the immediate impact of the crisis. So I would like to give the floor to the next presenter.
Thank you, Tida, for the floor. And now let's move on to my part, which is about the impact on firms. So, as we may know that the COVID-19 pandemic impact on various sectors in the country, such as household, firms, financial sector, and public finance. And tourism, retail, and part of the service sector were more severely affected by the public health policy. Lockdown in the public health measure needed to contain the pandemic. And as the survey data collected from more than 100,000 business worldwide show that in overall 70% of business closed at the peak of the first wave of the pandemic, and 84% of the firm report a drop in revenue in the first wave of the pandemic as well. And besides that, there was also a decline in sales in the large amount, which the firm experienced a 51% year-on-year reduction in revenue, and the average revenue was still more than 40% lower than it in the same period 1 year earlier. And the shock was sufficiently severe and long-lasting to threaten the survival of many firms and business. And in the early stage of the pandemic, 46% of firms expected to fail into areas on their outstanding supplier wage or loan payment over over the next 6 months, which means that in the next 6 months, the firm will be in a danger zone. And the average business reported having cash reserve to cover expense for less than 51 51 51 days. So as a result, the business or firm has the corresponding the reduction in employment, like mostly they reducing workers hour and the pay cut. And as a result, in total, 57% of survey firms reduce in employment. And here is some of the figures that show that the climb in sales and the business expectation to fall into the areas. And now let's move on to another part, which is about the small and informal business most severely affected. So the impact of the crisis on business was highly regressive, like that on household. And the most affected by the COVID-19 pandemic are the small business, informal business, and business with more limited access to formal credit market. And because the smaller firm tend to face more greater financial constraint, even in the advanced economy. So for example, in the US, in the United States, the medium small business have fewer than 15 days in cash reserve. And more than 15% of all small firms expected to fail into areas within 6 months of the onset of the crisis, compared with 45% of medium-sized firms and 36% of large firms. So we can see that the small firm is more affected than the large and the medium firm. And next one, women-led business has also been affected by the crisis, according to the data from the World Bank COVID-19 Business Plus Survey that conducted during the first year of the pandemic. Women-owned business are overall more concentrated in sectors that were hardly hit by lockdown and mobility the restriction. Women-owned business in the hospitality industry, for example, recorded a larger decline in sales revenue than male-led business during the same period the previous year. And the survey of some 26,000 business owners in over 50 countries with an active Facebook business page also revealed that the strictness of lockdown measure tended to exacerbate gender gap in temporary business closure. And next is about the persistent economic uncertainty hampering business activity. So, in addition to revenue losses, business activity has been affected by an uncharacteristically large and persistent increase in uncertainty about future business prospects. So, COVID-19 Business Plus survey conducted by the World Bank gather comparable data on business expectation around the world and found a very similar result. And the confirm that the higher level of uncertainty about company prospect are linked to the to larger job loss in the firm level and a long-term uncertainty regarding the recovery of compared revenue, even as a pandemic-related danger fades away, is likely to stifle job creation and investment by firms, as well as their capacity to obtain credit more from their lenders. So as we can see in the figure 1.8. So next is about the heightened fragility on corporate balance sheet. So the pre-crisis period saw a significant build-up of financial risk in the corporate sector, which became increasingly apparent with the onset of the pandemic. And this increase in risk was particularly severe in emerging markets. And prior to the crisis, many firms in emerging market were already struggling with unsustainable debt burden and difficulty covering short-term liabilities. And the stress test simulation using pre-crisis corporate balance sheets data indicate that an economic shock of the size experienced by most emerging from the COVID-19 recession would push a large share of firm in this economy into insolvency. So it means some of the financial risks that have accumulated among emerging market firms have become apparent as the result of the crisis. And since the beginning of the pandemic, the currency of many emerging markets has come under pressure. This create problem for firm and hold significant amounts of foreign currency, dominate debt, which is now more difficult to service because the value of the borrower's local currency revenue has fallen. And this is all from my part. So let's move to Tida. Yeah.
Thank you for the floor. So, next part is about the impact on the financial sector. So, in contrast to the immediate large impact of the COVID-19 crisis on the household and firm, the short-term impact of the crisis on financial sector are relatively mute because of the large-scale emergency support and the forbearance program for borrower at preventing a spike in the loan default. So the subpoint of this part talking about the moderate initial impact masking longer-term risk. So this part pointing out the extensive income support and debt forbearance policy that have helped the insulate the financial sector from a wave of the loan deficit in the short run. So it is like if any there's also the fewer country that they have the resource to keep this policy in place in a longer term. So therefore the financial institutions around the world are likely to come under the significant stress as a debt moratorium and the other support policy for the borrower are scaled back. So for example, the loan default has been on the rise in the India, Kenya, and the Philippines, and the other growing number of other middle income countries. So these emerged credit risks are also reflect in the worsening outlook of the main international rating agency for the financial institution as the forbearance policy are lift. So this means that it also shows that in many emerging economic countries, there are fragility in the financial sector are compounded by the extensive government ownership of the bank, and it also shows the misallocate of the stemming from the government lending program and the financial representing policy. So in the early year of the COVID-19 crisis, we see that the financial sector assessment program, a joint exercise carried out by the World Bank and the IMF, have highlighted the problem in the resolution of non-performing loan, the loan classification and provision, and the bank exposure to the non-banking sector. So um, there there has also been sufficient concern about the the growing rapidly growing of the non-bank financial institution known as the NBFI. So this sector have linking to the formal banking in many emerging markets, including China and India. Move to next slide, please. Thank you. So our next point is about the short-term government response and its impact on the public finance. So the COVID-19 crisis strategy is an extraordinary large government response at the stabilizing output and is also protecting the income in the short run. So the subpoint of this part talking about the variation in the scale of the policy response. So talking about the physical policy response to the COVID-19 crisis, it was swift and substantial. So it it consists of the primary of the direct of emergency payment to the household and firm most accounting effect by the sharp drop in the income and revenue. So many countries conduct a counter-cycle fiscal policy during the crisis, and it also a first for the most emergency economy. However, the scale of the response of the variety across the country is depending on the capacity of the government to mobilize the resource. So it is as well as the institution capability and the availability of the social safety. So as you see in the figure 1.10, so it showed that while the extent of the fiscal response was almost large by the history measure in the high-income country, so a small or non-existent in a low-income country, there was a significant difference in the size of the fiscal response among the middle-income country. It also showed that this variety reflect among the other factor the light difference in government debt burden and the ability to finance the crisis response. Um, so it means that the scale and the nature of the fiscal response were also shaped by the political economic factor. So to support the borrower and avoid avail of the private installed financial regulator also rolled out a variety of the temporary debt relief measure for household and business. So it was known as the debt moratorium and the other debt restructuring program. Um, so the debt moratorium is one of the on the scale of those implemented during the pandemic that are likely untested policy, and so far this is a can be known as it is one of the very little evidence of their longer term impact on the borrower behavior and financial stability. So it also shows that if they are in the long term, it will affect on the credit risk and also the financial lead to the financial fragility. So many countries also implement so-called and other policy named regulator forbidden policy for the bank. So it is one of the policy that it refer to the relaxation of the regulation requirement and the accountant standard in the hope that this will make it easier for the lender to issue a new credit. But this policy also can lead to the accumulation of the significant hidden of the credit risk. Move on to the next slide, please. Yeah, so in addition to the scale of the short-term crisis response, there was also a variation in the specific combination of the policy tool used by different countries. So This variation reflects the different inability to mobilize the resource as well as the different priority for the crisis response. So in the graph, you will see the fiscal, monetary, and the financial sector policy respond to the pandemic by the country that like the country income group. So for the low income country, it make relatively greater use of the simple cash transfer program, whereas the middle and high income country whose like their financial sector are much more exposed to household and small business debt. So they will going to make more extensive use of the financial sector policy, and it was aimed at to addressing the financial sector distress. Next slide, please. Yes, so the next point is going to talk about a global increase in government debt strategy by the pandemic. So while the light crisis response was necessary and effectively in integrating the in mitigating the worst effect of the crisis in the short run, it was showing the result that in the global crisis in government debt, it was like showing the rising new concern about the debt sustainability. So the government debt level have been rising over the last decade in many emerging economy, and there are also several suffering downgrade of their sovereignty risk rating prior the crisis. So apparently in 2020, it showed that 51 country among them, 44 emerging economy saw their credit rating deteriorate. So increase in the government debt stemming from the physical response to the pandemic there, like especially consequently from the particularly on the low income country. So as a result, in emerging and advanced economy, the physical response to the pandemic was supported by significant monetary policy measure that was unprecedented use of the new policy tool. And since the global finance crisis, the structural reform has helped to create the additional flexibility. Next slide, please. So here is our last slide. So um, it is talking about the interplay between the physical and the monetary policy. So in response to the pandemic, the country have made the extensive use of the monetary policy to support the large physical program that become necessary to support the household and the firm. But like many emerging economy found themselves they constrained in their crisis response because of their limited the fiscal and monetary policy option that was arising from the high level of government debt. And it has shown that many countries have adopted like different policy, like the unconventional monetary policy. So this term is referred to the policy instrument that go beyond the traditional regulation and interest rate setting power from the central bank. And the most like widely used instrument was the asset purchase program. So in which before the COVID-19 crisis, this instrument has used mostly like exclusively in advanced economy. So to respond the economic or like to respond to the pandemic between the March and August of 2020, there are 8 low income country, 11 lower middle income country, and 10 upper middle income country. They have like using the asset purchase program. So like however like there are several countries that have adopt another like program that require a change in the law of governing the operation of the central bank. So for example, like Brazil and Thailand, they have using the parliament to approve to buy their corporate bond. So from the figure, it has shown that the number of the country that introduced a set purchase program in response to the pandemic by the income group, and by whether the central bank was authorized to purchase government bond or corporate bond or both. So in short, the greater independence between the fiscal and monetary policy have suggested that the increased use of new monetary policy tool will require improved coordinating between the fiscal and monetary authorities. So it also, as well as the safeguard for the central bank independence, and in response to the emerging challenge, some emerging economy has also introduced the rule that isolate the central bank from the political pressure to finance government outside of the emergency situation. However, it's not possible to isolating the central bank. So overall, the rapid and decisive policy response to the COVID-19 crisis have mitigated the crisis was economic consequence in the short run. And however, some crisis response measures have maybe create a new risk that may imply a more equitable recovering in the long run. So I think that's all for our presentation. And the next slide is about our group have like creating the discussion question.
Okay, thank you. The presentation, it took about more than 1.5 hours. It's too long. Okay, too long presentation. I think the fact it's long because you take all the sentence and you don't reduce unnecessary words, so it keep and you keep reading this sentence, so it's make it much longer. So sometimes we can just pick a few words in each sentence and we can shorten it. Okay. Anyway, I think it's a lot, and I don't have much comment because we time, but I have question for Thierry. Okay, Thierry, are you there? Can you explain what is the visibility? What do you mean by visibility? Can you explain a little bit about this point?
Could you give me a second? Like
You present a keyword, okay, and the word is the visibility, okay, relating to the I think the credit risk in your part, okay. Can you explain the meaning of the word improving visibility, okay, and recourse in your part of the presentation? What is it mean by visibility? Can you clarify on that?
of the word visibility mean that the performance of the institution or um, um, just like the performance, how they perform, or any asset that is visible.
No, can you show your sentence again in the part that you do the presentation? Yeah, I think the next slide, I think it's I mean ensuring access to finance, and you say that mitigating risk by improving visibility and recourse. Okay, so what that mean by that statement? Can you clarify again? What kind of visibility is this? Okay. What is risk here? What is risk referring to here? What kind of risk?
Wait. So your question is that risk, the risk, the word risk here means that the risk that the borrower could not repay the loan to the lender.
Yes, correct. But so what it have to do with visibility? Why having visibility, then we can reduce this kind of risk that the borrower cannot pay back the loan.
I, I mean that the word visibility here means the performance of the institution. As you can see that in the pandemic, there is uncertainty about the economic around the world, so that
Oh, I know institution, but are you talking about the institution that provide loan or the institution that borrow loans?
The institution that borrow the loan.
Okay. So you're saying that I mean, like a bank need to actually able to see, okay, the performance of the borrowers, so they can better assess how risky when they provide loan to the borrower. Is that mean by your? Because I'm not quite sure. I just want to clarify that. Okay. The next question for you is that, can you explain what is sovereign debt to me again?
The word sovereign debt is from what I have present.
I think you have next slide, right? Next slide is your.
Next slide, yes.
Yeah.
The sovereign debt is a country's gross government debt. I mean it is the financial liability of the government. When it is so confused. Sovereign debt, it's like when the pandemic comes, the private sector is stuck, so they need a financial lender. So the government is the financial lender of last resort to the private sector, and when the government has landed all up their money in reserve, they need to borrow the money from the other country. So the money that borrowed from the other country is the sovereign debt.
Yeah, right. Correct. When we talk of sovereign debt, we mean the debt that is borrowed by the government. Okay, by the governments. Because there are two kinds of debt. It could be debt that you and me borrow, which is private debt, and we may have a public debt, that is the debt that is borrowed by the governments. And government can borrow either from inside the country or it can borrow from outside the countries. If they want to borrow from outside the country, they may go to, let's say, from China, like our country. We always borrow from the outside. From inside the country, government may borrow from anybody in the country, including the central bank, by selling the government bonds. But in our country, Cambodia, we do not have the government bond yet. Okay, so mostly we rely on the sovereign debt. And since the most of the government program to finance the recoveries, okay, if the financial condition is not so good, they will have to borrow more money, and that could leading to over indebtedness, okay, in which they may have cannot pay back. So that's why this part is telling about how to avoid the case that government increase the debt, okay, during that kind of pandemic crisis. Anyway, thank you for trying to give me the answer and clarification. Reiterate. I have a question for Tida. I think you show a slide and we show the impact on household, and we see the strategy that household coping with this, coping with impacts. I think you have a graph there, and I seem like you have something like stop working, right? In the chart, how the household actually cope, right? This one, figure I.1. I see in the case of we can see the dot represent different group of countries, right? And I see the low income country have the low percentage of stop workings. So it seemed like even during this COVID-19, then comparing to upper middle income, okay, the brown color and the lower middle income, then the low income country tend to have less, I mean, number who actually stop working. So do you think why would in low income country people still work in the COVID-19? Any idea about this?
So thank you like for the question. So I think that why the number of the low income countries still remain like the stop working still at that point, because like in the higher income country there are some of there are more loan and that like fewer than low income country, while the low income country they can like using like some of simple transfer point.
I just don't know, okay, but people still work, okay. I mean, the less percentage of people who stop working, only about 25% in the low income countries, okay. Because it seems like I guess they would have more people who are stop working, okay, in the low income countries, and here we have lower number. Anyway, I guess maybe they have to work regardless how I mean how serious the disease is, but because they are important source of income, they may not have the other alternative source to support the living. So that's why they continue to work, okay, even during the COVID-19. I have one remark about the intervention you show about the fiscal, monetary, and the financial intervention. Can you show the chart on that part? It's not a question. I just want to draw a quick look at this intervention. I think you have three group of intervention: the fiscal, monetary, and the financial. I think at the last slide, I think you have that. Next one, I think. Yes, that's one. No, the previous slide. Yes, previous one. Yeah, this one. I.11. Okay, so we see these are the measures that have been implemented by government in different countries, right? And they can use fiscal policy to support the vulnerable group to recover. They can use the monetary policy and the financial policy, financial sector policy. So when I look at this, I see that if we're looking at the monetary policy and financial sector policy, it seems like most of the country, regardless of low and high income or middle income, they turn to use this kind, right? You see more than 60% of this country, mostly they use this instrument to solve the problem of the COVID-19. However, when you look at the fiscal, you see they tend to scatter around. Okay, so there are variety, the difference between countries. Some country use more of this instrument, fiscal, and other countries use less. Okay, so there's a lot of variety in the fiscal policy. Okay, just a quick remark on that, not any question. Okay, so I just noticed this. I guess maybe the ability to use fiscal is depending more on how government get the money, the revenue, to finance their activity. And in low income country and country may differ. Their budget space, okay, are different from one country or to other countries. So that's why it's tend to have a lot of variations among country in terms of using the fiscal policy, okay, fiscal instrument. Okay, I think thank you. I like to go to your discussion question. We almost have run out of time. So can you show your question again? So these are the questions. Their impact on household, firm, and the financial sector and the public finance. Public finance, you meaning the government? I mean, can you clarify on that part? Question number 4. I mean, bullet number 4. Hello, Tida. Yeah.
Yes, like
So number 4, what
related
is public finance? You talking impact on the government budget or government finance?
on government budget, like the managing of the country revenue expenditure.
Okay.
On that note.
Okay. So so please look at this for impact and which impact should you be a priority in recovery? Okay. So which one you think are the most should be on the order of the first order, second order, and so on. Okay. So I think we have only 28 people. I like to put you into 5 rooms, and I like to get our people to have a presenter into each rooms. In room 1, I don't have our members here, and in room 2 I have Tida. In room 3 I have Mani and Chan. Wong Chan Visa, right? Not so Visa.
Yes, like.
Okay. So I will take Visa to room 1. Please wait a minute. Okay, I'm trying to make the I mean our presenter to each room so he or she will support our discussion. Please wait a minute. Okay. And in room 4, I have I don't have anybody. In room 5, I have Benjamin there. Okay, so room 4. Where is Retiri? Okay, I get Retiri from room 5 to room 4. Just wait a minute. Okay, I think we can start the discussion now, and you have 10 minutes, and then I will bring you back to the main room. Okay, hello back everyone. Sorry to bring you back to the main room because we almost run out of time. So I like to invite each room to share the discussions. So I like to invite room one. We have Lee Suchita, Saina, Samnang, Kivari, Chimeng, Satyanit, and Janvisar. Can you share the discussion, please?
Yes, good evening, lecturers and everyone. So after a 10-minute discussion with our group, we have decided to go for the recovery plan related to the public finance. Since in a developing country, um, most of the time the financial system is very young and fragile. So when we are witnessing economy shocks like the COVID-19 pandemics, developing countries are very vulnerable to having unstable financial position. For instance, we can see that there is an increase in poverty and as well as employment, and also a poor wealth distribution between the rich and the poor as well. So this is when the government needs to play an important role to restore back the entire financial system and as well the economy itself. It is very essential for the government to implement both monetary policies and as well as fiscal policy, for instance, such as issuing stimulus package and as well as injecting more money supplies, stabilize the exchange rate, and also probably giving tax holidays or deduction of interest rate to households and firms so that we can experience more consumptions and the economic recovery. Yes, so for all of this reason, we think that public finance is very essential in the recovery plan. Thank you, lecturer.
Okay, thank you, Vari, for sharing your room discussions. Next, I'd like to invite room two. Room two, we have Dane, Cao Dane, Sripik, Dalin, Charlie Hieng, Tida, and Sonita. Can you share your discussion, please?
Hello, teacher. Our room choose to our group. Our group choose to prioritize the impact on household because we think that reducing or extending the debt is could support the household in developing country because like after the pandemic, many households lost their income and they turn to borrowing money in order to make end meet and supporting day-to-day expenses. So which only make them get into more and more debt because there are no income or less income. So reducing and or suspending the debt could support each household in developing country. Thank you.
Okay, thank you, Nita from room two for sharing the room discussion. So that's all right. Room two.
Yes, sir, yes.
Okay, so I like to invite room three. We have Visal, and so Visal, Mani, Sun Ho, and Sik Kwang. Can you share your discussion, please?
Yes, for our group, and we think the we should priority to recover on firm because like in firm play an important role to earn the income for the developing country, and they also provide many jobs for the workers. So we think they should prioritize on to recover on the impact on firm, and the policy like the government can provide some loan, or like they can also reduce the tax or tariff to help them. Yes, and that's all from our group.
Okay, thank you, Sek Kwang from room 3 for sharing the discussion. Let me invite room 4. We have Sitikun, Senasa, Udom, and Panyarot, Morakat, and Retirit. Can you share the discussion, please?
So hello again everyone, I'm from room 4. So we think that the uh, the recovery plan that we prioritize is on the financial sector, because even before or during the COVID-19, people mark it as an important thing in the living as well, because we already prioritize the health. And the second would be focus on financial. So I think um, based on the policy, we're not pretty sure about it, but we thought that financial institutions should lower the rate of interest for people who have like borrowed a loan or debt to the bank, because it's just the thing that they need to make the full make profit for their living as well. And on the other hand, there's the supporting new lending, I guess, something that we could ask for the people who can make profit or stabilize their income, to help the people who cannot make profit to pay back to the banking or financial institution. So it could relieve the tension and reduce the penalty for people who pay late debt or loans. So they could make more profit and have the financial for themselves as well. That's all. Like.
Okay, thank you, Morakat, for sharing the room discussion. So let me invite the last room, room 5. We have Lian An, Sumtai, Vijamin, and David, please.
Good evening, teacher. So based on our group discussion, our group prioritize the financial sector as they are the primary driver of the economy, and they also provide the free flow of capital and liquidity in the marketplace. And besides, the financial sector also lend the money to firms, household, and business to borrow. So if they have a problem with the cash flow, it also affects to borrower and lenders. So in this case, the government should support the financial sector, such as providing the incentive to the financial sector. And the bank could also help by reducing reserve requirement from financial sector, and also lower interest rate so that the financial sector can remain financially stable in the post COVID-19, and also have to generate the economic growth. So that's all from my group.
Okay, thank you, Somtai from room 5 for sharing the room discussion. Well, let me conclude. I think I do agree with all of you about this. I think it's almost all the the listed sector are key important, regardless the household finance, public finance, or the firm and the financial sector. They are really important, and because they do depending on each others, and so I don't have any objection. It's up to your reasons. Okay. And I think it's quite sure that the public finance, like the government, actually perhaps played an important role, because they generally they have a big source of income which they have accumulated through tax, and they have power in regulating many regulatory framework, okay, including the financial system in the countries, and so they can have influence, okay, on the financial sector, okay? And financial sector, as you say, are so important because they provide the loan, okay, to the borrower and investor, and so we need to make sure they actually can keep going on providing the support, okay, and also forgiveness, okay, and for the lateness in repayment, okay, during this COVID-19. So I think that's all for what you say. It's true, okay. They all play important role and very important in this recovery process. In our country, we do see all of this. Okay, we do see government actually delay the tax payment, We do see the custom program to household. Okay, we do see government support for SME with some of the delay in tax payment, and we see the banking sector like NBC provide the restructure of the loan. Okay, to ease the situation for the borrowers. Okay, and so we see all of this. So all of you said is actually quite true that we have implemented all of this. And I think that's all. And I'd like to say thank you for joining the discussion up to this. And sorry for keep you over time on 8, almost 8:40. So we will meet again the next week. And please enjoy the evening and have a good time with your family. See you again next week. Goodbye.
Goodbye, like.
Thank you, like, goodbye.
Goodbye, teacher.
Goodbye, like.
Goodbye.